Hi, and welcome to the CostofCarry podcast. My name is James G, and thank you all for tuning in. Let's get started. Broker-originated loans account for around 60% of all loans written in Australia. This is an interesting statistic for a few reasons. The first is that the broker industry has been at the forefront of regulation, particularly over the past 4 years. Not to say that it hasn't happened before, but this hasn't stopped consumers approaching brokers. The second, the conditions of the market have changed significantly, especially now, and lenders aren't always accommodating to customers who come direct to them for residential or commercial lending. And lastly, simple scenarios aside, a broker is useful in navigating more complicated deals because of their knowledge in structuring information and presenting it, and also having the knowledge to place it at certain lenders. For broker-originated loans to be around the 60% mark, it means that the market has trust in the broker industry. But it also shows that the borrower wants to have someone to sort their finance out for them, and in a manner that best suits their needs. What this means is that going direct to the lender doesn't always yield the best outcomes for borrowers, because that one lender can only offer their products. Now, depending on the variety of accreditations that the broker has, as well as their experience and contact points at those lenders, the broker is not only able to find out more about what really matters with the borrower, but is also able to have the conversation with the bank as well to find out whether or not certain policies and situations can be factored into to make the deal work. I think this statistic gives a lot of weight to the concept of best interest. I mean, sure, it's hard to paint everyone in the same brushstroke, but acting in the best interest of the customer is only possible through an in-depth and high-level conversation about what they're looking to do. Do they want an offset facility? How long do they want to fix the loan for? What's the exit strategy? How concerned are they about their job security? Although these things may take time and it makes the search criteria more specific and hence reduces the amount of search results possible, it's important to remember that identifying the best interests during the fact find makes for a better customer outcome, which leads hopefully to repeat business and more referrals. If 3 out of 5 deals are being written through brokers, it means that the broker has the power to grow with the client and nurture the relationship and also maintain oversight over the client. That being said, when customers appreciate the time and effort that goes into guiding them through the lending environment, this figure can only be expected to grow. Why aren't loans at 0%? At 0%, for a lender to make any margin on that, it would mean that interest rates would have to be negative, and that would indicate severe deflation where money is losing value. This isn't ideal for appreciating property assets. The problem of coronavirus and the lower cash rate isn't going to be allowing more credit to flow if credit policy is too tight and the approval rate can't get through the system. We're now in August 2020, and there are a few basic residential and commercial rates out in the market starting in the low 2s and high 2s and low 3s respectively for residential and commercial lending. But that isn't to say that they will go up or down. This depends slightly on the borrower's rate structure. Say if you want to fix it or interest only, you got bad credit scores, things like that. But the interesting thing for potential borrowers to consider is that if rates go even lower, that doesn't necessarily mean that everyone is eligible for them. Similarly, if rates start rising, that doesn't mean that any lender will be willing to lend on all deals in the prospect of making more money simply because their interest rate's higher. As we're seeing with the situation occurring around Australia, and I'll use Victoria as the main example, as that's the one most featured in the news, and I hope everyone down there is going all right. The effect that the lockdown and the lack of business activity is having on the lending environment is that there is a little bit of not only nervousness, but there's also confusion about the capacity that certain borrowers, not only in Victoria but also out of state that also happen to be in the same industry, making further repayments. So for example, if a PAYG hairdresser, chef, bartender was trying to refinance their loan, which say sits somewhere between 50 or 80% on a loan to value ratio, the risk profile that these borrowers have is increasing by the day nearly, where their risk due to unemployment, particularly in those hospitality and retail industries. So I wouldn't say those types of borrowers would be rolling the dice, but there's definitely no guarantee that if they are successful in refinancing, that they'll end up getting a better rate or a better product than the one that they previously had. From the lender's perspective, it's clear that in order to get the super sharp rate, the borrower and the deal and the security they're looking for need to place nicely within their boxes or their books. That means, they're probably not going to be looking for any surprises or red flags or question marks. It's going to be a relatively low risk on their part or what they're looking for. That's also ties into the fact that interest rates can, or in most cases does, reflect the risk profile of the deal. So that means having a rate of 0% indicates something is significantly wrong, not only with the market and the lenders, but also with the government as well, since obviously the government is underpinning a certain position in the lending market as well. And obviously the RBA is also monitoring the situation. While cheaper rates are perceived as more favourable for borrowers, it's also important to remember what's underpinning these rates. Brokers are self-regulating themselves in line with what is expected of them. Now this one goes hand in hand with the opening discussion point. The broker industry does a lot of self-regulation. Not only are they always trying to, but they need to stay one step ahead of the regulation that's coming through. If we consider the regulation as a bare minimum or of what is expected and what's required, that's not always the best way to look at these types of things. But when brokers and aggregators and their lending partners get together and brainstorm ideas of not only how to best respond to these regulators, but also how to ensure that steps taken by their members shows commitment to servicing the industry and borrowers and the market, and also upholding the industry's reputation. So for example, viewing a PAYG borrower's last two pay slips and bank statements to show the income coming into account is sufficient, but it also may be necessary to go take that extra step and check with the employer regarding the customer's current employment history. And in doing so, also doing independent checks about the business, and especially in this time of coronavirus and uncertainty, it's important to also get those facts as well to see whether or not anyone's on JobKeeper or whether or not the business is struggling and things like that. So little things like these help brokers maintain their standards, and with the help of their stakeholders will ensure that they always perform their duties above what is expected of them. Don't get a loan simply to get a loan, and don't get pressured into a loan. Something I want to touch on quickly is the prevalence of financial abuse in the community, Australia-wide. Regardless of whether it occurs domestically, within the household, on the basis of age, gender, race, intelligence, wealth, or ability, being pressured into finance or debt commitments or being deprived of access to financial resources is a serious issue that creates a lot of harm not only to the victim but also to any of the facilitators whether or not they are knowing of what's happening. Especially in coronavirus, we're hearing some pretty disturbing headlines about financial abuse. Like, it also goes hand in hand with, domestic violence as well. It's important to distinguish between being pressured into a loan to get funds for something or someone else, and getting a loan simply to have the funds but not know when or how or what to use them for. In the first case, the motive is often to create a financial benefit through duress or deception, whereas in the second case, it's to willingly create a direct financial benefit, where some details are yet to be decided. So the second case is more like a conditional approval, obviously pending a purchase receipt, for example. There's a lot of literature and, like I said, media coverage of this type of behaviour from, community-based support groups all the way up to federal parliament. And it's always critical to be aware of what the signs of this behaviour are. And lastly, how should brokers interact with their clients? So to finish on a lighter note, if a broker has a Rolodex full of clients that they've settled loans or deals with, it's important for them to keep contact every once in a while, 1 or 2 months, as a checkup. Find out how the facility is tracking, if there are any issues with any of the loan features or with the bank's personnel, for example. Maybe they're looking to do something else soon, but they haven't decided yet and need some assistance in finding out more options for what's possible. And all these things are helpful not only in satisfying the customer's lending needs, but also keeping the broker fresh in their minds in case the customer is in a situation or in a conversation with one of their mates at a barbecue and they're talking about buying, for example, a new car and they need finance on. So, who knows where the conversation can arise, but if the broker has proven himself or herself as someone who can deliver credit guidance and assistance, then it's a good quality for a broker and an agent not only to show further interest in the client's business and needs and conduct as well. It also shows the customer that the broker values the trust that they've placed in them as a broker. Obviously respect and professionalism can go a very long way in nurturing a professional relationship, especially when you start moving into deals or situations where there's a lot of potential to grow with the client. And I think this is definitely something that I'm learning a lot about, and especially this whole era of the public health crisis and uncertainty. I think not only if the broker is reaching out in a financial sense or not so much looking for business, but also as an act of decency and good character, checking in to making sure everything's all right, checking in to see if they need any assistance with anything, like I said, I think is really appreciated in this day and age. In a genuine sense, if you care about your clients and your customers or potential customers, this may not necessarily reap rewards now, but it can open the doors to opportunities later down the track. So on that note, that concludes this episode of the CostofCarry podcast. Thank you all for tuning in, and I look forward to seeing you in the next episode.